My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Dave Kranzler, who has a couple of pandas on his Twitter profile. I want to see if there's some kind of special meeting there. But Dave, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets? And what are you doing currently?
Sure. Yeah. So my name's Dave Kranzler, and I worked on Wall Street basically from 1985 until 2000. I did a couple different jobs between college and business school. Went to business school, and when I came out in 1991, everyone said the junk bond market was dead. It was right after Drexel had gone belly up. And I think there was 2 of us in total from the top 10 business schools that went into the junk bond area of the big investment banks. And I traded junk bonds for 9 years and got tired of New York City and moved back to my home state of Colorado. And I've been kind of working for myself and day trading ever since 2000. I manage a small precious metals, physical bullion, and mining stock investment fund. And currently I also write and publish the Mining Stock Journal, which is a bi-weekly subscription newsletter focusing mainly on junior mining stocks. But I also have some producing miners in my portfolio, and also the Short Sellers Journal, which is actually a weekly newsletter, but kind of self-descriptive. So I've pretty much been involved in the financial markets. I guess, what's that now? 25 years, 35 years, whatever. Yeah, 35 years. So 37 years. Use my math. So that's me in a nutshell.
So you've seen a lot of interesting cycles along the way. And I always keep going back to the 1987 example, not to say that we're going to have a Black Monday, but as a parallel to what may be happening this year, in the sense that everyone always talks about the crash of 87, but they forget that the Dow was up 38% or so for the crash of 87. You had a crash, you had a Fed pivot, and it was a pre-election year. You lived through that. Talk about just how that year played out as you remember it, and if you find any parallels to what's happening now.
Sure. It's actually kind of funny because when I came out of college, I did back then they were 2-year analyst programs at the big investment banks. So I was a 2-year fixed income analyst at Goldman Sachs, and I was having too much fun living in New York City and wasn't ready to go back to business school yet. And so I took another job at it was basically a small LBO firm. And I literally, the first day I started was the day of that crash. And I remember I got there and, the grunts who were working there, we kind of looked at each other and like, oh, I wonder if we're going to have a job tomorrow. So, boy, that was a long time ago. That was still when Drexel was kind of doing its thing. It was kind of peaking as a junk bond underwriter. And, that back then, that's when we had the corporate raiders, and a lot of them were financed by Michael Milken. A lot of them got rich because of Milken. Specifically, guys like Carl Icahn, Milken helped him make, he made most of it on his own after that, but Milken helped get him started. So, and I don't know if you remember, but back then, the big thing was something called portfolio insurance. And it was based on the Fisher Black portfolio or options models. And the narrative was that, we can run a hyper long investment fund with limited downside because we have portfolio insurance. And if the market, sells off, the portfolio insurance will cover the losses on the long side. I don't know if you remember that or if you were around back then. Well, as it turned out, they didn't model in excess of a 2 sigma event, which is basically what we had. And so what happened was as the market started going down, people started buying more and more of this insurance and dumping their longs, and it exacerbated the sell-off. It's, since I've been involved, the financial markets, especially the stock markets, have been kind of a wash, rinse, repeat cycle. Basically had the same thing in 1998 when long-term capital went tits up. I don't know if you remember that, but they had all these Nobel laureates working at their shop, doing fancy derivatives models. And they supposedly, similar to the portfolio insurance in the mid 80s, they supposedly had it figured out how to completely hedge the downside risk. Well, we saw how well that worked out, right?
And sorry, and not to but I think it's interesting, right? Because I've argued that before, and I don't know how about the comparison is to the portfolio insurance dynamic, but you have now zero DTE. You've got these buffer type of products, which everybody went into, especially last year. I just wonder if these kind of let's call them in quotes structural innovations end up being sort of their own downfall.
Well, they do, and so I've always felt that part of the problem is that within events that occur within a randomly normal distribution bell curve, right? So maybe within a 2 sigma event, right? So within 2 standard deviations of what you might expect, these derivatives, et cetera, are, they're probably going to work. But the problem is they don't price in the tail risk. And really what the problem is, if Wall Street were to price these derivatives such that they did price in excess of 2 sigma events, people wouldn't buy them because it wouldn't make sense to put up all that money, right? It's like you got to pay through the nose for the possibility of extreme events, and no one's going to do that if they have to pay up like that. So that's why they don't work, is because when you start to get an event that's beyond a 2 sigma event, like the 87 market crash, or what happened with long-term capital, or what we saw in the type of crash that we had in March of 2020. The problem with these, fancy mathematical financial instruments, aka derivatives, is that they don't have tail risk priced into them, because if they priced in the tail risk, no one would buy them. They'd be very expensive. And so Wall Street just says, "Oh, well, we're not going to see beyond a 2 sigma event, and so and besides, the Fed will bail us out if we fuck it up." So, and that's what we've seen. We saw it in 87. We saw it with long-term capital. We saw it in March of 2020. People kind of ignore. I mean, that was basically a stock market crash, and the COVID situation is used as the cover story, but if you look at charts and look at all the data and look at what the Fed was doing back then, if you recall, they actually started, a disguised QE program in September of 2019. And that's because the banks were becoming illiquid. And then they turned it into, it got bigger and bigger until finally they used the COVID cover story to put, $3 billion all at once in the financial system. And ultimately they printed another, a total of another $4+ billion. And I think it's interesting that people kind of ignore the crash that really happened in March. And that crash was going to happen whether we had the COVID thing or not. In my opinion, that's what I would argue. And I think that what we're seeing now with, the gamma squeeze dynamic, and those aren't really, that's not really the kind of derivative situation that's hedging downside risk. But you've got, the big Wall Street market makers, when hedge funds and retail start piling into these 0 DTE and 1 DTE call options that are slightly out of the money, the market makers have to go long a certain amount of stock to hedge. They're shorting the calls to be market makers, and they have to hedge it out with a certain amount of stock. And, ostensibly it's profitable for them because a lot of those calls end up expiring worthless and they're hedged out with the stock, right? Well, at some point, we're going to get a downside dislocation in the stock market, and who knows what will cause it. Hell, maybe the Fed, I'm not saying this is what I think is going to happen, but as an example, the Fed could come out today and say, you know what? Housing prices are still going up. Rent's still going up. Gasoline's moving higher. Food prices are still going up. We're not touching, we haven't really touched inflation in a significant way with these interest rate hikes. And this is not just one and done. We think we're going to need a whole series of interest rates increases, and we may have to take it over 6%. Boom. That's going to cause a downside dislocation in the stock market, and won't just be the call option, the guys who piled in the call options that lose their shirt. It's going to be these Wall Street banks, because they went long all this stock, and they're going to start dumping it hand over fist. And that's going to cause a big move down in the stock market.
It's funny. I floated that idea out yesterday, this idea that the simplest answer is probably the right one, to the extent that the, in quotes, housing reacceleration is because of the wealth effect from the stock market. And if you need to really break inflation, you've got to break housing. Then maybe Powell actually wants the stock market to go down to put some pressure on home prices to get it back to the 2% inflation rate.
Yeah, well, it's not just home prices. It's a lot of things, and we're going to start seeing energy go up again, and rents going up. I know, at least in Denver, and some of the figures I've seen on a national basis, rent's still rising. food is still rising. So, and I think, in my opinion, and, this is based on studying economic and monetary economics for a long time, watching the Fed for a long time. It's not just interest rate hikes. See, the interest rate hikes are geared at trying to subdue demand, right? So let's raise hikes, let's raise interest rates. It's going to slow down home buyers, which it has, and it's going to slow down demand. But the real source of inflation is all that money the Fed has printed. I mean, think about how much they've printed since 2008. The balance sheet got up to almost $9 trillion. And right now, despite this, everyone jumping up and down and Fed making a lot of noise about quantitative tightening, I mean, the amount that the Fed's balance sheet has been reduced is infinitesimal as a percentage of the amount that they printed. And so, and then, and it's not just the Fed's, the size of the Fed's balance sheet. And, really what they're doing is they're creating reserves. Well, then the banks can take those reserves and leverage those up. And so, a lot of the banking reserves have to be reduced, and the Fed's balance sheet has to be reduced by a significant amount in order, in my opinion, in order for them to really attack the real source of inflation. I mean, yeah, we had some supply issues that exacerbated the problem, but now the supply issues are largely cleared up. There's excess supply of a lot of things. I mean, you got big retailers like Walmart and Target. They canceled billions of dollars worth of inventory orders over the last 6 to 9 months because they're sitting on too much inventory. Certainly oil right now and gasoline doesn't seem to be in any shortage of supply. So, what have the interest rate hikes done? You've gone from 0% up to, after today, it'll be 5.5% on the Fed funds rate. And yet the inflation rate as measured by the CPI. And I trust that most, if not your entire audience, understands that the CPI is total bullshit. It's not designed to measure inflation. It's designed to enable the government to present what they want you to think inflation is. I default to John Williams' shadow statistics, his alternative inflation number. And that's showing the annualized rate of inflation that's still north of 10%. So yeah, the Fed has brought the rate of price inflation down a little bit, but I mean, it's not like, and that's another thing that really pisses me off. Now everyone's, deflation is like the term du jour. Oh, well, now we're worried about deflation. Well, if you look at a chart, you can just go to the St. Louis Fed database and pull up a chart of the CPI index. It's gone up a lot over the last, call it 15 years, and it's not coming down. It's still pretty much at the same level. Prices are still increasing. So it's not like we're seeing deflation at all, right? I mean, it's incredible the way the mainstream propaganda tries to shape the way people are looking at things, and it's 180 degrees from the truth.
By the way, you mentioned that point earlier about that the sort of disguised QE from 2019. As the regional bank in quote crisis was taking place, I put out a tweet that went viral that sounded a little conspiratorial, but pre-election years tend to be the strongest of the cycle for the stock market. Pre-election years tend to be strong because of stimulus, and I floated that out in March saying, how do you stimulate when you have high inflation through a manufactured banking crisis? Which is basically what happened with a form of stealth QE in using that as an excuse. So you can argue that what we've seen this year is, to your point, there was spin around the regional banks that gave them cover.
Yes, absolutely. I mean, there's no way in hell that that the government should and the Fed should be putting in a safety net for the uninsured depositors. I mean, it's full disclosure. If you put your money in a bank, you're guaranteed up to 250 grand, right? And if you put more, if you put more than that, the bank's going to lend it out, and these regional banks were piling that money into bad commercial real estate bets. That's on you. You're a creditor of the bank. And what's overlooked, and what I would argue is the reason that the stock market we've had this last leg of this, what I call an echo bubble, an echo stock bubble, is tied to the $400 billion that the Fed put into the banking system at the end of March, right? And there's always going to be a lag between when the Fed puts money into the banking system by creating reserves. That's what they're doing when they print money. And there's going to be a lag between when the Fed does that and when it transmits into the financial markets. And if you pull up a chart I just pull up a chart of the NASDAQ here, I was looking at it the other day. when I was thinking about this. If you look at a chart, this last leg of the move higher in the NASDAQ, I mean, it's gone up 1,400 points since the end of May. So you had basically about an 8-week lag between when the Fed injected that money into the banking system and when we've had this last leg higher. But see, now that money has in a way been pulled out because the Fed's balance sheet is now a little bit lower than it was right before they put that 400 billion in. And so that's why I think this latest rally is running on fumes, because the money that was printed and thrown at the banking system, thrown into the financial system that triggered this rally, that's been taken out. And so I think at some point we're going to start to see this market roll over. I loathe to put timing on it. We may be topping out right now, depending on what the Fed says today. Obviously, if they take a dovish stance on what their future moves are going to be, we'll probably see, another spike higher. But the point here being is that liquidity that caused this last leg higher has now been removed from the financial system. And I think that we're probably, and who knows, it may not happen until September, October, because that's when it seems like, stock market accidents tend to happen, but it could easily start to happen, sometime in August.
So you sent me a DM saying that you think we're already in a recession, and the yield curve, it's pretty much still screaming recession. Sarcastically, I said the yield curve only matters when the stock market's going down, right? Nobody cares about the yield curve being inverted, in this kind of move that we've had. Lay out the argument. Why do you think we're either in a recession or extremely close to one?
Sure. Well, first of all, I find it really highly amusing that, and I'm sure you've seen this narrative out there. Oh, well, the inversion in the yield curve means something different than it has historically, right? I'm sure you've seen that. It's like they're putting lipstick on the pig and expecting people to believe it. Well, no. I mean, the yield curve has been inverted now for about a year, and that is foretelling of the severity of what's in front of us in terms of economic contraction, aka recession, aka depression. And so, it's always different this time, right? Like in the late 1990s, the internet is making everything different. Well, how do you value it? Well, clicks and eyeballs. Remember that? And of course, we had a tech crash. And now that the narrative is AI is going to solve all our problems. Oh, we're not going to have a recession because of AI. Well, no one has been able to lay out for me exactly the financial and economic benefit that AI is going to create. I mean, we know it's going to replace jobs, and that's a negative economic benefit. So, but to circle back to, why I think we're in a recession, I mean, it's not that I think it, it's just what the numbers are showing me. And first of all, we had 2 quarters in a row of real GDP decline, real being when they report the numbers, that it's on a nominal basis. So if you strip out inflation, the GDP actually contracted, and that's supposed to be definitionally, the definition of a recession. But, they decided, no, it's not a recession yet. But if you look at hard economic data, and when I say hard economic data, I'm talking about the data, some of the Federal Reserve economic reports, and, everything you can get your hands on that gets reported in the private sector, it's showing, a contraction in economic activity. And particularly if for the data series where they're priced in dollars and nominal dollars, if you remove just the CPI inflation component, don't use a real inflation number, just use the number that the government's feeding us, that we've been in an economic contraction in several areas of the economy for, was this July? Probably at least the beginning of the year, if not before that. And if you just look at manufacturing output, how about the housing market? I mean, yeah, these home builders are reporting decent numbers right now, but for the most part, if you look at their deliveries, the home deliveries are declining. And the reason why they're reporting good numbers now is because their costs have come down somewhat, and their price, new home prices are at an all-time high. So yeah, of course, the revenue line is going to look good. But, if you take D.R. Horton, for example, their operating income and their net income was down pretty substantially on a quarterly basis year over year. And if you look at their new orders were flat. However, they've also had to start discounting their prices in order to move homes and discount them pretty substantially. And so I know someone who recently bought a DR Horton home. His wife was bugging him, because they had been renting since 2018. And he finally capitulated and bought a house. And he knows he's probably buying it at the top of the market, but, happy wife, happy life. So he told me, he goes, not only did they show me the house at a discount to the listed price, they offered me another $30,000 discount on top of that. And they were trying hard to get me to take a loan to do a rate buy down mortgage, because that's part of how they make up for their discount. They underwrite the rate buy down mortgage and then they flip that mortgage at a profit into a mortgage trust because it's a conforming mortgage, right? So that means they can sell it to bond trust because it's guaranteed by Fannie or Freddie or whatever. So, but anyway, the point here being is that if you look at the unit backlog of DR Horton and also the dollar value of their backlog, it's down like 35+% on a year over year basis. And so that means their business is actually contracting, right? The amount of homes that they're moving is declining. And the economic benefit of each home that they sell is declining. And that's a reset.
Just to reset the room for the remaining 15 minutes or so. Everybody, please make sure you follow Dave Kranzler here on Twitter. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be in podcast on all of your favorite platforms under Lead Lag Live. You had mentioned the experience creating junk bonds. And junk bonds have been, you can argue, confounding relative to bankruptcies and credit stress, which is happening in the real economy, but not necessarily the bond market on the public side. Any thoughts on the way junk bonds have been trading here? If you think there's just sort of an enormous disconnect as I do as it relates to default risk?
Oh, 100%. 100%. And again, it's the credit markets have been the beneficiary as much as the stock market has from all the money printing, right? And so, except for, even at the lowest CCC rated paper, that's still trading. When I was trading junk bonds, CCC rated paper would be yielding 20+%. And now you're seeing CCC paper that, maybe is at 10%. And that's from all the money that the Fed has printed. The Fed has removed price discovery from the credit markets with all the money that it's printed and with all the support that it's given Wall Street. And, we saw the same thing just as when the stock market was running up, junk bond spreads started tightening in again. And part of that is because junk bond investment funds, they see that, the stock market's going higher. So junk bonds are less risky because the equity value sitting below my junk bonds is higher now. And also it's just a pure systemic liquidity issue where the money, is going to flow into treasuries. And, we saw the yield curve shift down this spring and it's actually starting to shift back out. And then money goes into the investment grade bonds and investment grade spreads tightened in. And then the money has now flowed into the junk bond market and junk bond credit spreads have tightened in. And, again, especially given the fact that you're seeing bankruptcies now are on the rise. I think I saw a statistic that said corporate bankruptcies are as high as they were in 2009, right? And that situation is going to get worse. The companies are earning less money. They're getting squeezed by inflation just like households are. And so, when you buy a junk bond or buy a junk bond fund that might be yielding, 150 or 200 or 300 over the equivalent duration treasury, you're not getting compensated for the risk of actually investing in those junk bonds. And especially for entities that are buying individual junk bonds because, this thing's yielding 5%, and that's giving me, I guess it wouldn't be 5%. It's yielding, 250 over the 10 years. So I guess that would be about 6%, and that's a good yield in this market. Well, you're not getting compensated for the risk that company is going to eventually hit the wall. So, that's what my take on the junk bond market. And I agree with you. I think the stock market's a ticking time bomb, and I also think the credit markets are a ticking time bomb.
Yeah, no, I don't disagree. Now, I want to pivot that a little bit to a discussion around precious metals, gold in particular. As I talk to advisors and talk to investors like I do every day, I've been making the argument that if you're on the edge of a risk-off, credit event type of moment, that becomes almost the perfect catalyst for gold to break out of its, multi-year high that ceiling it hasn't been able to do for a long time. But talk through the trading and then separately the investment case for gold, because they're going to be very different.
I don't recommend that, the average investor tries to day trade or swing trade gold and silver. Really, the reason why you buy gold, and again, I recommend first and foremost that you buy physical metal, physical gold and silver, bullion coins that you safekeep yourself. Because once you buy that gold and silver and it's sitting in your closet or sitting in your safe, that money is disconnected completely from the financial system. It's yours. No one has to know about it. And that's your wealth preservation. That's your protection. And so that's what my advice is in terms of, if you decide that you want to move a portion of your investment portfolio into the precious metals, I wouldn't recommend GLD, SLV. Let me take that back. I guess if you do think we're in a situation where we're going to get a move higher and you have enough gold and silver, you feel comfortable with how much you hold, well then, yeah, you can use GLD or SLV as kind of an intermediate term trading vehicle. But again, you're not looking to get rich off of gold and silver. You're looking to preserve your wealth, where you can leverage what I think is going to be a big move at some point in the price of gold and silver is buying the mining stocks. And, again, I wouldn't recommend going all into the mining stocks, but I think especially right now, because the sector has been beaten down so much, I think with a well-structured mining stock portfolio, you're investing into an asset that's going to generate alpha and it's going to outperform the rest of the financial market. Once this sector, as you mentioned, it breaks out of its historical highs and moves higher. And I think that's coming. And part of why I think that's coming is that the current prices for gold and silver, and ordinarily, I don't like to discuss the trading and the pricing of gold and silver without introducing or without also including, the manipulation aspect, the price capping aspect, the official intervention in the price discovery process. That in my mind, that's settled history. And if anybody, is interested in it, go to gata.org and go to their archive and start at the year 2000 and just read through a bunch of things that have been posted over the last 22, 23 years. And I think if you go through that exercise, you'll be pretty convinced that there is indeed official price discovery intervention in the precious metal sector. And certainly the motive is there for central banks and governments to make that happen. However, if you look at the price of gold, I just started 2001, right? And you compare that versus the Dow and the S&P, gold has actually outperformed over that time period. It's outperformed just about every single financial asset class. I think there's some, oddball commodities that maybe outperform gold. And silver, I believe, has been the number 2 or number 3 performer. And so currently, again, in my opinion, I do not believe that the market price that we observe every day does not reflect, the amount of money that has been printed by central banks globally. And it's not just the Fed, it's every central bank. The Chinese central bank, obviously all the Western European central banks, all these central banks have been printing money because that's how they've managed to keep their financial markets alive and their banking systems above water. And so I don't think that the price of gold relative to the global money supply, it used to be a chart that, the gold freak like me we used to look at that stuff all the time in the first decade of this century. And after a while, I got kind of bored of it. But the price of gold relative to the reservoir of money that's out there floating around globally is at a very low relative level relative to history. And, silver it's the same thing with silver. Only, silver, when this market takes off again, silver is going to outperform gold. So, and it's not just the money supply. I think it's also the price of gold and silver don't reflect just the overall systemic risk globally, and particularly in the United States. And it doesn't reflect the geopolitical risk that's out there. I mean, obviously, it seems like every day there's more news that comes out that, at least concerns me about how tension is escalating between the United States and Russia and China. And I just don't think that, well, I don't think the stock market reflects that risk. And the price of gold and silver certainly do not at all reflect that risk. And just one more element I'll throw in there, and if you just, run a chart that shows the ratio of gold to the S&P 500 and go take that chart back to the year 2000. And you can do the same thing you can take GDX, that same chart for GDX, and go back to 2006, or I use the either XAU or Amex Gold Bug Index, the Huey, and you can take that back to 2000. And if you look at that ratio, it is almost as low as it was when this secular precious metals bull market started, late 2000, early 2001. That rate, so in other words, the precious metals sector is cheap relative to the stock market, the S&P 500, the NASDAQ, the Dow is cheap on a historical basis relative to those stock indices. And it's almost as cheap as it was when this secular bull market got started. And so, that's the case that I would make for, buying physical gold and silver primarily, and then secondarily investing in the sector as a potential total rate of return asset sector.
So you mentioned that you yourself are doing day trading and other things with your portfolio. What areas are you focusing on? And are you more on the long or the short side?
Well, with the mining stocks, right now I'm just in buy and hold mode because again, I think we have a big move coming ahead of us. And, I think right now the mining stock sector is just completely out of favor. The sentiment is as bad as I've seen it, in the 2011 to late 2015 period. And it's as bad as it was. I jumped into this sector in 2001. Not that many people were doing it back then, but the sentiment was bad. And then the sentiment was also bad, really bad in the summer of 2008. And I think the current period that we're in is pretty similar in a lot of ways to the summer of 2008. So for me, I don't try to trade the mining stocks. Well, I take that back. I do jump in and out of call options and I use Hecla just because it's silver focused, even though it produces a lot of gold. But it just from what I've observed over the last several years, whenever we get a move higher in gold and silver, Hecla seems to outperform the other silver producers or the other companies that have silver as a big part of their production component. So I do trade around Hecla options, but everything else is just buy and hold. And if we have another leg down in the sector before the end of the summer, which we could, I'll take some of my favorite junior mining stock ideas and buy more of them. So in terms of what the non-precious metal sector, people would probably call me a perma bear. And I guess, if I want to be honest, I'm probably guilty of being a perma bear, but I honestly believe that the financial markets in total, but especially the stock market, has been overvalued for a long time. And I don't even think it got down to fair value in March 2009 when it bottomed after, in the great financial crisis. I think it still could have gone lower before it reflected true fundamental value. And so I tend to, everything else I do is shorting stocks and buying, either, if I'm day trading or weekly trading, put options, I do that, but I also buy longer dated out of the money put options. And that, that's pretty much how I express my view of the stock market right now.
Given your years of experience in markets and seeing all kinds of cycles, is this cycle particularly strange or unusual compared to, what you've gone through? And I'm going beyond just sort of the advent of retail and zero DTE, but do you get a sense that just market movement in general is more bizarre, for lack of a better way of saying it?
It is and it isn't. I think that this current cycle rhymes with previous cycles, and I'm going back to, the 87 crash, but, particularly the tech bubble era and the great financial crisis era, this sector, this period of time that we're in kind of in many ways rhymes with those because, you had all the same elements, only it's much larger in scale, right? The Fed money printing and it, you can't just look at that. You got to look at, when the government prints up treasury bonds and sells them, that also contributes to the amount of credit and leverage that's in the system. And, obviously the US government has more debt outstanding now, and particularly as a percentage of GDP than it ever has. So, just everything that has caused boom and busts in the previous cycle going back to the mid 80s, it's the same. It's just much larger in scale now, which leads me to believe that, the fallout from it's going to be much more painful and much larger in scale. But as you point out, yes, the trading relationships and just the trading in general in all the markets is a lot crazier now and a lot more, in one way, unexplainable, but in a way explainable than in previous cycles. And I attribute all of that to the degree of monetary intervention that has gone on by all central banks, but particularly by the Fed. I mean, the Fed's been the biggest offender of printing money. And what it's done is it's, just like we're seeing in the credit markets now with investment grade and junk bond spreads, it's, the Fed has, well, the central banks in general, I'm just going to say the Fed, just to make it easy, has pretty much removed any element of true price discovery out of all of the markets and across all asset classes. And that goes from housing to the stock market, to the credit markets, to derivatives. And I think that's why you're seeing just, all the crazy moves that we see in the market and the crazy cross correlations.
I think that's a good place to wrap this Twitter Space up. Dave, for those who want to track more of your thoughts, where would you point them to?
Well, I don't post as much as I need to, but I've got a blog, investmentresearchdynamics.com. And actually there's links on the top of that blog where you can find out more about my newsletters. And then, for better or for worse, I'm an active tweeter on Twitter, or I don't know, are we supposed to call it X now?
I call it Chitter. It's going to be X. I call it Chitter, Berkeley.
That's a good adjective for it. Or I guess that would be a verb.
I don't know what it is, man. It's the whole thing is bizarre, but that's a whole nother topic.
So yeah, and if you just search on my name, Dave Kranzler, you pull up my Twitter feed, and I have been suspended from Twitter a few times in the past. So I'm probably not as obnoxious as I used to be, but I'm sure I offend some people.
Well, you haven't been blocked by me yet, so that's a big plus. Because I blocked a lot of people, so you're in good shape on that end. Everybody, please make sure you follow Dave, and hopefully I'll see you all. Thank you, Dave. Appreciate it.
Thank you, Michael.